It's no secret we're living in pretty volatile times when it comes to the world of finance, with all of the new tariffs, as well as a lot of uncertainty here in the United States as well as in other countries. It's getting really difficult to understand what's coming next and knowing exactly what you need to do with your money moving forward. So I'm trying to help answer that question. And just a few days ago, I caught up with Confluent CEO Yogesh Prasad to ask him a few questions about how we as investors can protect our money. And I'm here to share exactly what he said to hopefully give everyone a little bit of an edge moving forward as we try to navigate the uncertainty in the markets. The first thing I covered with Yogesh was what exactly does diversification mean in 2025? You hear it all the time, you read it all the time, people talk about it, but what does it really mean and how do we put it into effect, especially when investing our money as individual investors? And here's what he had to say. So, a big topic I see people discussing all the time is diversification. But what is diversification and why exactly is it important?
Yeah, that's a very good question, 'cause especially when the market volatility is high. Basically, what it means is market runs in cycles, right? So at every point in cycles, one asset class will outperform the other asset classes. And diversification means is you need to place your assets or allocate your investment assets in a way that it seals your portfolio against a bad returns on any particular assets. So, for example, you want to have, let's say, someone who's younger who wants to allocate because they're looking for growth and they have a longer time horizon so they can stomach a drawdown of, let's say, 30-40% over the next 20 years. They should be more allocated towards equities and less towards fixed income. But if someone who's starting a family or closer to retirement, the allocation shifts away from equities, which is more riskier, and goes more towards the safer assets like fixed income or maybe a cash flowing assets like real estate. So if you build an asset allocation portfolio like this, which is well diversified, you are very well positioned to absorb any volatility or unexpected events in the market.
Got it. I think that makes a lot of sense, and it's a pretty eloquent breakdown. If I wanted to start diversifying my own portfolio today, how would I go about that?
Sure. So the way our advisors at Confluent works is we look at the risk and return profile of each and individual clients, be it a younger client, they're in the mid stage of their life, or towards the retirement. And then the way we map it out is okay, what is your time horizon? What kind of returns you're looking for to meet your long-term and mid-term financial goals, and then we allocate assets accordingly based on their risk appetite. So if younger, as I mentioned, probably goes more risky assets. If older, probably goes more safer assets like fixed income, and somewhere in the middle range like 40, 50, starting new families, they have a very good diversified portfolio mix of equities, fixed income, real estates, and alternative assets.
Next thing I covered with him was a term called hedging. It's a strategy that not a lot of people necessarily implement, and to be honest, a lot of people don't really understand it, but he was able to break it down in a little bit simpler terms and hopefully shed some light on why it would be beneficial for protecting investments. Can you explain what hedging is and give us an example of what it would look like?
Definitely, yeah. Hedging is just think of a life insurance. So how you hedge the loss of human capital through life insurance. Similarly, you can hedge your portfolio or any particular asset classes against any losses. For common tools, usually you use to hedge are options, futures, or inverse ETFs. One of the example I can give you is, let's say you buy Apple and you're worried about Apple going down. So what you can do is you can buy option on the stock itself, and then option gives you a right to sell at a particular price which is predetermined. So you know that okay, if some Apple goes down, you can still sell it at a much higher prices.
Finally, we covered risk management and why managing risk is just as important as any other piece of investing. And he shed a little light on why and how you can manage risk to maybe give yourself an edge over the competition when it comes to investing, especially during a volatile time like we're living in right now. And what about risk management? How does that come into play here?
Yeah, definitely. Risk management is different than hedging. There are many ways you can manage risk of your portfolio. The way we do it at Confluent is we use rule-based risk management. So, for instance, we have a stop loss rule where if we buy a position, we open a position, and if it has a loss at certain threshold levels, we trim the position or we get out of it. On the upside, we make sure that we continue to take profits as it hits certain thresholds because we want to book those gains. If in case the market pulls back or the stock itself pulls back, we're gonna book those gains and be benefited out of it.
Hopefully, these questions and Yogesh's answers could help just a little bit with the struggles that many people are kind of facing when investing right now. And hopefully, it gives them a direction to look and a chance to overcome some of the adversity they're facing. We've got more information and useful tips just like this over on our webpage and on our channel. So go ahead, click the links in the description, come see what we have to offer, and hopefully you can use that information to level up your finances, your portfolio, and really attack the uncertainty and volatility head on.